wonder if you could share some of the differences, the key differences in terms of valuation as it relates to REITs and direct real estate. I know there's been conversations we've had with clients that about including one or both in a retirement plan, but I wanted to get a sense, and we've had these conversations about valuation, wanted to get your perspective on valuation between the two different types of vehicles.
Certainly. Valuation is a little easier to get a handle on through the public markets than it is through the private markets, because in the case of the public markets, through listed REITs, they're trading every day. So most of them trade on the New York Stock Exchange. So it's easy to get a sense of the current value, all right? But to put that into some context, particularly those who are looking at investing in public markets, many of the traditional metrics that investors are comfortable looking at when they evaluate the value in other equities apply just as well to listed REITs. So earnings price multiples is one valuation metric that people look at. Another metric, however, is to compare the value at which the stock trades relative to the value of the underlying assets. It's sort of like the discount or premium to book value that investors are used to looking at when they evaluate equities. And that also provides a tie-in to the private side of the market. So that information is readily available, that investors can estimate the actual value of the properties in the REIT portfolio, and then look to see how the value of those properties are reflected in the share price, and basically calculate what the discount or premium is of the share price relative to the net asset value. The acronym for often which is used is NAV. All right, so that's a fairly common and popular method for determining valuations. I can tell you that in recent months, REIT share prices have actually traded at a discount to their estimated net asset value. Not a large discount. I think most recently it's probably about 5%. But there seems to be a consensus, I think, in the market that REIT stock prices today are probably fairly valued. It's not, a deep discount. It's also not a premium.
So thank you for that. And I think what you're talking about just underscores the necessity for a lot of understanding for committees. So we're working with committees, people who are very intelligent but may not have this level of expertise. And it's incumbent upon us as consultants and advisors and professionals to really understand the process by which valuations are done to properly explain it to the plan fiduciary. So thank you for explaining that to the audience.
Sure. Jeff, if I could add to that, though, I think it's important to recognize and acknowledge that particularly for retirement plan investments, investors should be thinking of the long term, right? They should have a long investment horizon. And in particular, real estate is a long-term investment, all right? So the buildings that we see behind us, they've been there for a long time. They're going to continue to be there for a long time, all right? They will perform. They will be leased to their tenants. Those tenants will pay rent, and through listed equity REITs, those rents will be paid out to shareholders in the form of dividends. And that will provide a regular stream of ongoing income for a long period of time. So I personally don't focus too much on what current valuations are. I know many investors are always interested in that, and I understand that. But the record of performance is a long-term record. And I think that's the preferred way to look at that as a permanent allocation to your portfolio.
Agreed. I was just, in terms of what we do as a firm, just educating the plan sponsors to at least understand the process. But I think we're in agreement that, these have a merit in retirement plans, both in the target date fund, which is a common fund in these programs, and also as a separate allocation. And that's just prudent to understand the valuation process by how they function. This is REIT Week, so this is exciting. You're here in town, talk about REIT Week. There's some big news in terms of classifications. The Global Industry Classification Standard, I actually had to write it down because I wouldn't be able to
yes.
articulate that.
Mouthful.
But can you help the audience understand what is GICS? And maybe we'll put like a little chyron at the bottom that actually writes this out. But what is GICS?
Yes. GICS is an acronym for, as you described, the Global Industry Classification Standard. So what is the Global Industry Classification Standard? The GICS system, which was developed and introduced in 1999 by S&P Dow Jones Indices and MSCI, is a method of classifying or categorizing companies that are in like businesses. So if you want to analyze the equity market, either for developing investment policies, asset allocations, researching the performance of different segments of the stock market and the different segments of the economy, you have 4,000 or so companies out there, 4,000 publicly traded equities. That's a rather ambitious way to address some of those issues. So GICS provides a method of identifying companies that are in similar businesses and putting them in similar categories. So, for example, all commercial banks are in a particular category. All insurance companies are in their own category. All pharmaceutical companies and drug manufacturing companies are in a particular category. All telecommunication services companies are in a particular category. And these categories then provide a certain amount of structure, organization, coherence that helps make the analysis of equity investments, the equity market in the US, develop investment strategies, a little easier to manage. GICS has a number of levels. Actually, it has 4 levels of classifications, but the highest, the most prominent, the most visible, the dominant classification is the headline level, which is called the sector. And today there are 10 sectors in GICS. And those sectors include telecommunication services, materials, pharmaceuticals, information resources, all of those things. And it also includes a sector called financials. And in the financial sector are commercial banks, insurance companies, finance companies, other financial service providers, and REITs and other real estate companies.